My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. The people who make friends, I'm just trying to save you some money. My job is not just to entertain, but to educate and teach you, so call me at 1-800-743-CNBC or tweet me at Jim Cramer. If you're like me, you're sick of reading that we're headed for an inevitable train wreck, that things are about to get terrible,
the house of pain,
that the banks will destroy the entire market,
sell.
that the Fed has to cut rates, not raise rates. So why not bail from the entire asset class that is stocks, and we are in the house of stocks, before disaster strikes?
House of pleasure.
No. That's how we get another ugly day like today, where the Dow tumbled 287 points, the S&P lost 0.72%, and the Nasdaq shed only 0.49%, and that does matter, so stay tuned. Even though the train wreck might seem inevitable right now, there are plenty of things that could happen to keep the proverbial train on the tracks, and we could get to
House of pleasure.
See? They come off. They do anything I want. Let me walk you through my wish list, because when you go down, and you go down, and you go down, you usually find yourself at a point where it's just not worth selling anymore.
Sell.
All week I've been telling you need to get right through this gauntlet, right? The gauntlet, well, here we go. This is what we're looking at. The 4 hurdles that must be jumped. We had the Fed meeting, okay. Apple's earnings, that was this evening. Employment report tomorrow morning at 8:30. And the debt ceiling, well, that's just hanging all over us like an attic. Before we get to where buying stocks makes sense, well, I think it's a little more nuanced than that. I did think, though, we cleared the first hurdle, the Fed meeting, with ease. And, man, was I ever wrong about that. Not only did the Fed misunderstand the terrain and set us back by appearing totally oblivious to the current regional bank crisis,
They know nothing.
but we've now had 4 bank failures: Silicon Valley, Signature, Silvergate. But then earlier this week, we had First Republic. The first 3 have been irresponsible quirks that rendered their business model useless and reckless in the face of the Fed's rapid rate hikes. First Republic, though, was different. Sure, they made risky loans that others wouldn't touch, loans with low or no interest to attract or keep rich clients. But they didn't have many particularly bad loans, nor did they have a hyper-concentrated deposit base that could flee at a moment's notice based on a few scary tweets, the way that they had at Silicon Valley Bank. Until a couple of months ago, First Republic was actually a pretty good outfit. And that's what makes this thing so much more unnerving than the Fed seemed to realize.
They know nothing.
We even thought that First Republic could be saved after a group of larger banks tossed them $30 billion in deposits to tide them over. For a while, it seemed like they were okay, but you know they really weren't. I knew it. You knew it. David Faber, my partner in the morning, we all knew it. Except for the FDIC. See, the FDIC was blindsided. Next thing you know, the bank had to be prickly given away to J.P. Morgan at 3 a.m. on Monday morning. How did that happen? Only J.P. Morgan seemed to know how to do it. So they, of course, made out like bandits. Small price to pay to save all those depositors? I don't know. I wish the FDIC had done a better, more thoughtful job. Actually, I wish they had done any job. Their lack of a plan, their very cluelessness, has us in the jam we are in now. I blame them, not the Fed. But the Fed should have realized that they were dealing with a group of people who were way over their heads. Once First Republic went under, smart money managers knew that they could bring the rest of the regional banks to their knees simply by aggressively shorting a regional bank ETF. And there are 2 of them, and they're just laying them. They're selling on them like, man, I can see it. Why can't the people in charge see it? See, the selling in the ETFs crushes the stocks that are underneath, and it's causing tremendous damage to all of the bank's stocks, good and bad. That all they happen to be is just stuck. They happen to be in the misfortune of being in these ETFs. If you crush the stocks, as we saw in 2008, you can cause a genuine bank run on its own, because wealthier depositors see the action in the stock of their bank, and they flee, seemingly to safer financial institutions. They flee to J.P. Morgan. Didn't the FDIC do that? Didn't they see that? Didn't they know they were going to drive all the money to J.P. Morgan? So do the small businesses and charities that are in these unfortunate institutions. They have to get their money out. The fiduciaries will take that money out despite the bank's assurances because the stocks knocked down by ETF short sellers just scare the heck out of anyone. Nobody who's got a balance over the FDIC's $250,000 deposit insurance cap can even afford to stick around. It's too dangerous. Now, I would have thought Fed Chief Jay Powell realized this ahead of the meeting, but he focused solely on the initial wave of failures in March. It was like he didn't know what was happening in April. It was like blindsided by current events. It's like he didn't follow the First Republic saga and he was on autopilot. That's not like him. And I knew there was big trouble, as I said last night, when I saw him misread the room so badly. The moment his press conference was over, smart hedge fund managers immediately went to work, literally, immediately. And what were they doing? Well, they were machine gutting fish in a barrel. I don't want to mention the bank's names, but every single regional bank in these ETFs is now in danger of being the next First Republic. And none of them deserves to be. But they happen to be in the ETFs, and the FDIC just doesn't understand that way it works. Fortunately, there is an easy way to avoid the financial train wreck, and if they're listening to me, they will do this. The FDIC tomorrow morning, well, actually even sooner than that, just has to say, we will ensure the deposits of banks that have invested their money responsibly. If there are no credit problems in the portfolio, and we know and we've reviewed your portfolios, that's what we do for a living, we're going to bless you. And that includes the following banks. Then all they have to do is list the most heavily shorted regionals in the ETFs. That's all they have to do. They don't understand that. Look, I know stocks. They know banks. I'm smarter than them at stocks. They're smarter than me at banks. It's all right. Now, some might say the FTC needs congressional approval to make this happen. That's a real stupid thing. See, legally, sure, that's an objection. But regional banks are everywhere. No member of Congress ever wants to cross them, just like nobody wants to cross the auto dealerships. You see, these banks are the bread and butter of local economies. So it's easy to fix it. All the FDIC says that they have to do it, and then they can go apologize to Congress, which will embrace them and say, thank you for helping us save our local banks. So that's their solution. I offer it. They should take it. If they don't, then I will hound them until they are. I'll hound them to the ends of the earth because it's your money that I'm worried about. I don't know what they're worried about. Second hurdle is Apple. Well, you know, Tim Cook, he was money in the bank the whole time. Largest company in the world reported tonight, and it was fine. Sure, Apple had a down quarter year over year, but the sales and earnings were both meaningfully better than expected, which is good enough for me. Let's just say box check. We cleared the hurdle with a few centimeters to spare. You know what I always say is own Apple, don't trade it. But I heard 5 or 6 people in the last 24 hours tell me to trade the heck out of it. I hate those people. I'm back into a hate mode, and I'm really good at it if I have to be. We try to jump the third hurdle tomorrow morning with the Labor Department's non-farm payroll report. Right now, we've made major strides in the fight against inflation. Gasoline's down year over year. Supply chains have been fixed. Most shortages are over. A lot of the commodities are down. But we still have wage inflation. That's what the Fed's most afraid of. Fortunately, I think wage inflation's cooling. Why? Okay, immigration started up. By the way, more people have immigrated in the last 6 months than in the last 6 years. And a lot of the immigrants, guess what? They like to work. They like to support their families. They want their kids to go to college. They're like us. That means more workers for the labor shortage. Meanwhile, we've gone through a prolonged period where new hires had to be trained to do their jobs. Guess what? They're now trained. At the same token, people who took time off there for COVID hit us are coming back to the office now that their free money's run out. And don't forget Chat AI. That's laying off people left and right. So I think we can clear the wage inflation hurdle tomorrow morning. Again, only by a few centimeters, though. Finally, and this is the slightly longer-term problem, we got to solve the debt crisis. Here I still am. I believe we'll have more mayhem like we saw the last time this happened in 2011, where the real issue is whether the rating agencies downgrade the U.S. debt, not what's happening at the Congress. Now, I don't want it to go that far, but you need to keep some cash on the sidelines. When we rally, if we do rally on the last 3 things that I'm talking about, you can do some selling so you get ready for the debt crisis. What has to happen here? First, stop listening to the experts who say we shouldn't worry about not getting a deal, like the Democrats and Republicans who come on TV all the time and try to reassure us when they're really out to get us. That's the same nonsense we heard in 2011. They were out to get us. They lied through their teeth. They got away with it. They're pals. The averages dropped 19%, though, and you got hurt. Even if there's a deal, I don't expect it to come to the 11th hour, like last time. But if that happens, the market may have already fallen a bit from this point. So why not wait to do some buying? Well, if we clear tomorrow's labor hurdle, then the market will rally. However, it will only be a tradable run because there's enough lunatics in Congress to ensure that the debt ceiling negotiations go down to the wire. We get a another a downgrade by the S&P, and that's going to cause pain. If we do rally short term, I recommend taking some profits and then stealing yourself for the debt ceiling fiasco, and then you can buy more. That's exactly what we're doing for the charitable trust. Why don't you join the club and find out rather than have me blather on about it? In the end, though, we need the FDIC to actually do something, stop the bank crisis. That's the game changer. If that happens, the market can go higher, at least until we get to the worst phase of the debt ceiling. I want the FDIC to act this evening. They don't understand stocks. I do. They should wake up or...
They know nothing!
Bottom line, once we jump the debt ceiling hurdle, I'm feeling much more optimistic about the market. Hey, by the way, I even saw an IPO window reopen. That's right, successful spin-off of Kenvue, J&J's consumer business. We just need to make it through the gauntlet. It will happen. Gather some money if the market gets higher, and then get ready to buy it back when the politicians make sure that they take every one of all of your money if you don't play this one right. We'll get through this. We have for 19 years. We're going to get through this one together. Let me go to Jimmy in Kentucky. Jimmy.
Happy Booyah, Jim.
How you doing?
I'm doing fine, but right now I'm in the house of pain, it seems like, from Bank of America. I'm long, and I cannot understand why record profits, record numbers, and the stock going down.
Well, I'll tell you the truth.
It
It doesn't matter, Jimmy, because the level of confidence in banks has been undermined by everybody. And because the FDIC has been so poorly doing its job, and believe me, I am going to hound them to the ends of the earth, people like Jimmy in Kentucky are getting hurt. FDIC, there are 340 million Jimmys in Kentucky. Wake up and do your job, or hire me and I'll do it for you. We have to get through this gauntlet before the market can meaningfully go higher. But we will get through it. We always do. Raise some cash on a rally and then get ready, put it back to work when the Pauls almost take everything you have, and that's when we'll act. On Mad Money tonight, a real snapshot of our economy, from snacking to infrastructure and tech to engines. We're getting to read on what's really impacting this market. Man, I can't believe we did all this today. Straight from the sources, we've got some unbelievable companies. We've got Kellogg, we've got Martin Marietta, we got Shopify, and we got Cummins. What a show. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.